All right, welcome to today's webinar, Setting Strategic Investment Objectives in the Wake of COVID-19, presented by BMO Global Asset Management. My name is Rachel Pine, and I look after content for the PLSA's conferences and training. As most of us are aware, recent guidance from the Pensions Regulator states that trustees should review their current investment and governance arrangements to ensure they remain appropriate in order that decisions can be made quickly. Prior to the pandemic, the Competition and Markets Authority set out an order requiring trustees to set objectives for anyone who provides investment advice to them, including investment consultants and fiduciary managers. Today's webinar will discuss what these objectives are, how to measure them, how often they should be measured, and what the next steps are. And now, I'm pleased to introduce Christy Jesudasan, who is the Director of UK Fiduciary Solutions at BMO. Over to you, Christy.
Welcome. Thank you on behalf of BMO Global Asset Management. We're very pleased that you can join us today. Clearly, looking at the number of trustees who've registered today, over 50, this is an important topic. And we're very pleased to be able to share our insights on this topic with you today. I'd like to make this as interactive as possible. Like Rachel said, we've got some polls, and I'd like to start off with the first one. If we can get that up. How did you set the strategic investment objectives for your advisor? So I'll give you a few minutes to complete that. Whilst that's up, I'm very pleased to say that I've got a panel of experts to help in the discussions today. Firstly, David Hickey, who's Head of Fiduciary Management at BMO Global Asset Management, and he's also the lead advisor on a number of our fiduciary clients. Peter Dorwood, Managing Director at IC Select. They're an independent firm who assists trustee boards in selecting and reviewing advisors, both in terms of investment consultants and fiduciary managers. And last but not least, Leanne Walsh, Head of Structuring within the BMO Solutions team, and also a trustee on a large pension scheme. So we'll have the perspective of an advisor, third-party evaluator, and a trustee. If we can now turn to the agenda. So the focus for today will be very much on how you set the strategic objectives and a balanced scorecard approach. However, we would be quite remiss if we didn't touch on COVID-19. Clearly, that's something that's affecting all of us, trustees from a governance and investment perspective. So I'll be handing over to David quite shortly to touch on that. I can see that the results of the first poll is up, and I guess it's quite understandable that most of the approach taken by many trustees is the one tabled by your consultant. Given the time, that's understandable, but we do have some views on that, and Peter will touch on that later on. So if I can now hand over to David Hickey.
Thanks, Christy. Good afternoon, everyone. Thanks for joining us today. And just give a little bit of introduction to myself. And then I've only got one slide, which should please everybody. My background, I'm a chartered accountant, and I've spent most of my career in pensions, initially in banking, and then around about a decade in fiduciary management. And my first job was actually in performance attribution in a bank. And what that meant was I had to sort of work out how to validate the P&L and the balance sheet of some rather complicated products. And so this involved lots of metrics. You might have all heard the term of the Greeks. So I had to do a lot of maths and work out how to track these complex products. So I've got a keen eye and, let's say, an enthusiasm about making sure things are measured correctly. And, you know, with that, I'd like to bring up my one chart, if you will. Now, there's one chart, there's 3 lines, and this is the experience of pension schemes over Q1. Now, you can determine which pension scheme you are, but the top line, the blue line at the top, is a very de-risked pension scheme. And that has got about 90% in matching assets, 10% in growth, and 100% liability hedged. But even that scheme has weathered a bit of a storm in Q1 with credit spreads widening, down 4 or 5% over the quarter. The bottom line, the grey line, well, that's a pretty sort of high-risk scheme. It's got 80% in growth, 20% in gilts, no real LDI. And that pension scheme's taken a real correction in Q1. But the middle line is the average pension scheme experience for DB from the PPF weightings. And that average experience is down 10% on the quarter. So what? Okay, a lot of volatility. Equities down 30%, back up, credit down sort of 10%. But the question I want you to ask yourselves when you're going through the pack today, and when you're going through some rather sort of interesting and technical measurement tools that are brought forward by IC Select, the question is, how accountable is your advisor for this chart? Okay, now it'll depend very much on the mandate you've set them. But you might also want to consider how accountable are the trustees? How accountable are the asset managers? Perhaps also, how accountable is the corporate sponsor? Could they have funded the scheme to avoid taking investment risk? Now, we all know that how advice is formed. We've all been in the pensions market for a long time, and we all know that advisors come up with long-term assumptions, and they look at long-term returns on equities over 50 years, and they look at long-term bond returns. And with that, they sort of tell you to take a balanced approach, diversified approach to portfolio management. And they'll also say, well, you should be active, but not too much. Don't let the tail wag the dog. And they'll cite a very old report that says you should, let sort of 80% of your risk come from what they call beta or the markets and 20% from active. So if we all know that many advisors sort of will advertise their philosophy, you kind of know what you're going to get. And so when you see a market like this, we can't be too surprised that many pension schemes are taking a bit of a hit. And, the alternative would be to go for one of the advisors that talks a lot more about absolute return strategies. And where we prepared as an industry to say, well, okay, we'll go for these more expensive techniques. And, they'll probably lag in a bull market, but they might outperform in a down market. We prepared to sit through the last bull market and incur those higher costs, and many won't have done that. And so in reality, this is a result that we expect, given that we know many advisors profess to use beta to get you there. So again, as we step forward, I'm just concluding on my section, I want you to ask, as you're going through the metrics, how accountable is your advisor for this chart?
And if I can come in here again, perhaps this is a good time to ask the next polling question. In light of COVID-19, are you comfortable with how your strategy and advisors have responded? I'll give you a few minutes to complete that, and then we'll shortly move on to Peter.
Just while that's we're waiting for you to consider that and answer that, Christy, I'll just quickly jump in. Good afternoon, everybody. Great to be able to speak to you and see you in a way that we didn't expect to see you. I'm going to be talking about and provide you with some detail about how you can set and to measure your strategic investment objectives. And we're going to look at various different aspects of that as well. My background, just to finish the picture that David started, is as MD of IC Select currently, so for the last 6 years working on investment governance aspect of DB pension schemes in the UK, with a background of investment management, not managing money, but from a product investment governance and operational perspective, both in the UK and overseas. So bring a practical aspect to the guidance that we give DB pensions trustee boards.
So I can see that the poll question results are in. So 61% of you are very happy with both. So that's good to hear. And I think, you know, hopefully there's still some food for thought in terms of when we go through this process in the next section, areas for improvement. So clearly that's also been noted here as well.
Okay, thanks, Christy, for that interesting insight. So moving on then to the detail of what I've just indicated we're going to talk about. On slide 6, you see the key elements of the CMA final orders that we all had the pleasure of seeing last year. And obviously within that we had the setting of strategic investment objectives slides. So so moving on then to slide 8, another picture that you'll all be familiar with. The reason I put this up really is just to focus your attention for a moment on what, in the short term anyway, what you can really control or influence. So clearly you've got covenant, and covenant is obviously something that you need to be focused on, something that you get guidance on, but in reality one of the legs of the stool that you can't really influence. It is what it is, and the impact of the last 6 or so weeks is going to be what it is as well. You just need to deal with that where you can. Similarly, to a degree, funding again impacted by contributions. So our deficit repair contributions going to continue to be paid. We don't know the impact of the last period and the impact of the strength of covenant on the ability of the sponsor to be able to do that as well. Can you influence that? Not really. But what you can influence, and what you will be and are heavily engaged in, I'm sure today, is investment. And that is whether you are making decisions yourselves as a trustee board under advice within an investment advisory relationship, or whether you've delegated that to a fiduciary manager and are overseeing what is going on and how they're reacting and how they're dealing with the current situation. But that alone emphasizes the need to get the strategic investment objectives right, but also ensure that having done that, you make sure that you've got the right framework in place to be able to measure those objectives. But why investment, and how should this manifest in the objectives? What we're seeing in a lot of the work that has been done in setting those objectives is a variety of approaches, a variety of quality, I have to say, of objectives, principally being set by consultants, which is what we've seen in the earlier poll question. So advisors effectively setting their own homework, if you like. But also a lot focused on changes in funding level and achieving a funding level objective. Now, lots of things influence funding level, and investment return, as you can see from this slide, relative to liabilities is only one element of that. This isn't an exhaustive list, but liability changes and assumptions, mortality assumptions, contributions, payments out, transfer values paid out, as well as investment return also change funding level. So our view very strongly is that you need to focus and ensure that your strategic investment objectives are focused on just that, on investment return, the influence that your advisor can really have in that regard. I said I would talk about the framework, and I promise I will in a moment. But before that, I want you just to pose a question of yourselves. What are you hoping to gain from this? And that's not the obvious thing. But let's think for a moment. You have to do this. It's mandated upon you to do it. So you need to get some value out of it. How much value is to be determined by you? And when you determine that, it will also determine just how much detail you go into and what sort of measurement you adopt and what framework you adopt to be able to measure the objectives. So looking at the top left of the slide, which is the bit I'm going to refer to in detail, are you trying to achieve by measurement of the objectives just a general guidance on how things have gone? So not in a really formal way, not in necessarily a quantitative way, but just getting a sense of how things are going against the objectives? Or are you actually trying to use this as a key driver to improve service? So if you think about a high jumper who sets the bar at a certain level, and then when the high jumper gets over the bar is raised. So the bar continually raising. Are you trying to raise that bar in terms of return and in terms of overall service? Service in the wider sense, I suppose, in relation to your objectives. Or the third option or aspiration could be, are you looking at this as an input to determine whether you should review your investment advisors? So a much more fundamental question. And depending on the answer to the question, which aspiration is your aspiration, will determine just how detailed you get in terms of your approach. Is it a straightforward RAG approach of red, amber, and green flags with fairly loose definitions? Or is it much more detailed, perhaps still with red, amber, and green indicators, but with clear definitions and scoring sitting behind it? Something for you to ponder while we go through the rest of this. So, I said we'd talk about creating a framework, and that's what we're about to do. So the framework that the TPR, the regulator, has talked about is a balanced scorecard framework. We fed into the work that the TPR was doing, as well as others, and fundamentally support that sort of framework, building also on the experience that we've got of the Dutch market, where balanced scorecards have been adopted for many years as a way to measure advisors and the fiduciary management services that are offered to Dutch pension funds. Balanced scorecard are balanced because it combines both elements of qualitative as well as quantitative assessment. So recognizing that there are different aspects to the framework that can be measured and some that can't be measured as easily. What we do feel is that the TPR's guidance on what this should look like is, in some sense, we worry is creating an industry around this with many measures not necessarily focused in the right areas. Our approach, which you'll see shortly, does focus on the key elements. So making sure that it is the right approach for you, tailored for your scheme to achieve the right things. And the approach is ultimately leading to an overall score, as you can see on the slide, based on, first of all, normally around 3 factors, which is the greenish area, which then leads on to 2 or 3 areas within each of those factors, and finally leading to objectives relating to those areas, and all weighted appropriately to reflect the importance of each of those within the balanced scorecard for that trustee or those trustees. Then if we look at an actual example, and after this I'm going to pause briefly. So this is an example of a balanced scorecard and the factors and the areas that we think should be or could be adopted to reflect measurement of the strategic investment objectives. The 4 factors you can see: financial performance, advice, ESG, and relationship. We break out ESG separately because we think, because of its focus now and the importance to trustees and to members and to chairs, of course, that it is important enough to be a separate factor contained within the balanced scorecard. For each of those factors, we then have 3 or 4 areas. So for financial performance, for instance, you've got achieve investment objective, you've got manage risk appropriately, you've got managing costs effectively. There may be others. Some may consider that costs should be sitting somewhere else, for instance, or there may be other areas that you want to add in. So those are the factors, those are the areas, and those are the sort of weightings that we have worked through with other trustee boards. This in particular is an example of a scheme that went recently to a fiduciary management relationship or framework. And that is why you see two levels of weighting, one for year 0 and one for year 5 or year 5 and beyond. And that reflects how important financial performance is, not important, but where value can be added to achieve financial performance by your advisor in those early years, compared with the importance of quality advice in those early years. And that is why, in this case, weighting shifted and increased in financial performance to 60% after year 5. So this just an example, and an example of how that will change, because the balanced scorecard will always be dynamic and will always reflect what is going on at any particular point of time for a particular trustee board. Financial performance is something that you would look at from a quantitative perspective, of course. Relationship right at the bottom there, just as another example, would be more qualitative. So providing training and understanding trustees' needs, or a demonstration of understanding trustees' needs. We're going to look at actual objectives in a moment, so you can see where quantitative and qualitative aspects will work together in the balanced scorecard. But before doing that, I'll just pass over to Christy, David and Leanne for any observations or questions.
Thank you, Peter, for setting the scene. So at this point, I'd like to just pause, get in the views of Leanne and David, but also the audience. So perhaps if we could put forward the next polling question, which will be, do you feel comfortable using a balanced scorecard approach like this? So whilst you're completing that, I'd like to ask Leanne the first question, which is, as a trustee, how do you react to this proposed scorecard?
Yeah, I think it's very useful. I think trustees have got a lot on their plate, and it's what I really like about the example, especially the example that was put up, is there is the focus on the non-quantitative aspects, which are equally as important, but because they are because they can be difficult to assess, therefore, you know, it may be tempting not to include those. So, for example, I mean, I really like the fact that it's got something on there about understanding the trustee needs, because every trustee board has different levels of governance, wants a different relationship from their investment consultant. Some will want just to have the investment consultant give them the options, but then give them their specific view. Others will want to have more detail at their disposal. So I think that's really important.
Okay, I can see the results are quite clear. Yes, but need to tailor further. And I think we'll, as we continue, we'll touch on that in the next section. David, if I can bring you in here, what's BMO's experience in this area?
First of all, Christy, it appears I haven't done my scenario testing. I didn't consider that the man next door wants to do some drilling in his wall, which he's doing right now. So if anyone can pick that up, best laid plans, etc., etc. So two observations on this. I mean, first of all, I like the style of it. It's sufficiently quantitative to give you something to work with as trustees. But I operate in the fiduciary space, but 80% of the market is advisory. And for me, what really matters in advisory is proactivity. Proactivity of advice, bringing ideas forward, whether they're used or not. And that to me sort of is something I'd like to embed in that advice layer, kind of much more heavily, more generally. And you can define yourself what you mean by proactivity and how much you want to be engaged with your advisor. But there's a whole range of asset classes out there that you're probably not using. There's opportunities that come and go. And from my point of view, I think trustees should be aware of the opportunities they're taking and the ones they're not taking. So I like to see a lot of proactivity coming through. Probably the second point I'd like to mention is that, Peter, you talk about having it different in year 1 and then to years 2, 3, 4, and 5. Doesn't COVID-19 how flexible this plan would have to be? Right now, for example, with funding levels jumping all over.
Right, it looks like David is frozen in time. Perhaps that's a cue to move on.
I'll comment on David's question, which I think I got the thrust of the start of it anyway. I did mention, but perhaps didn't reinforce the fact that this approach, this framework, is supposed to be dynamic. It is supposed to reflect that different things will be important to the trustees at different points in time, and also their expectation of advisors or fiduciary managers as their advisors will be different as a consequence of that. So it will change, it will flex. The objectives are not set in stone, or sorry, the objectives shouldn't be set in stone. So they can change, but also the weightings should be able to change as well.
Thank you, Peter. Actually, whilst we're waiting for David to come back in, maybe Leanne, I can ask you another question. Do you see, I mean, what are the kind of challenges that you see as a trustee in implementing this, or even reacting to some of the legislation that we're seeing in the market?
I mean, I think now more than ever, there's a lot of responsibility and a lot of onus on trustees. And whilst something like this, which you know, it's important to tailor it to your specific scheme, which may seem like quite a lot of work at the start, but in the longer run, it will actually save a lot of time and effort. So I think it's important it's important to make sure that this is prioritised and that you do put enough work into it now. But as has already been said, it does need to be dynamic, and you shouldn't be afraid of going back and changing aspects, changing the weightings, adding something in as your experience over time may lead you to change your opinions on these things. And I think it's also important just to note that, you know, as a trustee, even though you rely on your advisors, there is still a responsibility, to assess them, to hold them to account. So, and maybe sometimes even they need to sort of get their hands dirty and work. There was a recent example we had regarding some advice on our scheme that we'd had from the trustee, that we'd had from our advisors. But some of the data that fed into that didn't necessarily didn't exactly tally with the information we were getting from the actuary. Now, as we're a technical scheme, and I'm in particular have a very technical role, I could get involved and sort of try and work out, you know, was the basis of the information or the change the advisor had to make suitable, but that can be a lot more difficult for smaller schemes that don't have that skill set in there.
Thank you, Leanne. I can see that the questions are now starting to come through the audience. There's one aimed at David. So the question here, David mentions advisors being proactive and putting forward ideas. That's all very well, but many of those ideas will be opportunities for them to incur further charges, probably borne by the employer. To what extent should trustees be careful in ensuring that not too many good ideas come forward from their investment advisor? And perhaps, David, you might touch on that, and others on the panel as well.
Thanks, Christy. Yeah, I'm back online there, so I just dropped off for a moment. Fair point. When you're paid by the hour, I guess you might rack up some costs. Nothing stops the advisor from tabling interesting and relevant topics in a menu on a regular basis at no cost that you can then choose from, I suppose. In addition, you could opt for a more flat fee model. Obviously, I'm in the fiduciary space. That's how that operates. So it's kind of once you've set the fee, then all the advice that's necessary is included. But you know, if I look at what BMO has been doing in the last few weeks, first of all, we called every client, we spoke to every client, we made sure that they understood what we were doing in their portfolios. But then every Monday morning, we're sending around a short circular which talks about what's going on in the markets and what the government's doing to respond. I mean, that's something which can apply to all. It's relatively scalable, doesn't incur a lot of cost. And the biggest challenge, and when I got cut off earlier, was it's about working out what each board actually needs, and each board needs a different level of proactivity. But it shouldn't stop the advisor from seeking to be proactive, and the board should say that's the right amount of information or too much. But too often for me, we see a more reactive behaviour. Where was the proactive communication 3 months ago, for example?
So I'll just make a comment. First of all, Leanne, thanks for the recognition around the qualitative and quantitative aspects. I think it is challenging for trustees, given the breadth of stuff that is hitting them at the moment. So this is not trying to overcomplicate things, it's trying to actually make it easier ultimately for them to accede to what is mandated upon them for this. David, the proactivity question I think is a good one. If you'd seen an older version of this template that we just talked at on slide 11, you would have seen proactivity in that template, in that scorecard. We have been challenged more often than not in discussions with trustee boards that it may, and I guess this is where your questioner has come from, that it may drive the inappropriate behaviours from the advisor, and then rack up fees and so on and so forth. But to your point around the fiduciary management structure, obviously that's a very different approach and a different game, and allows more proactivity in a sense without the trustees being concerned about the impact on cost, for them to be able to consider those things. I guess trustees are still wary of being sold the latest fad, which I know will really barb with you for me to say that, but you know that is a concern that trustees can sometimes have.
Just to add to that, I think that's an important point, but it's also it's very easy to assess the decisions that you made to switch into new asset classes, but it's really difficult to assess sort of regret risk, or if something, you know, it's tough to balance, and I don't think there is one set answer for every scheme. I think it's a very personal decision to make, but it's really important that you understand what you're not investing in as well, or what options you're deciding not to take, because they will also have an impact in the performance of the scheme. So not an easy one, I'm afraid, but I do think that it is important to understand, for maybe you need to get the level of detail correct with your advisor and look at how they produce those ideas. But it is important to stay in touch with what's going on in the market, because you can end up missing out on an opportunity that's ideal for the scheme.
I would agree. Ultimately, we would agree that proactivity has a place within the framework to be measured somewhere.
Thank you for the answers, and please do keep the questions coming in. Peter, shall we continue on with the presentation? I guess that looking back at the last poll, you know, you were looking to add a bit more flesh to the bone.
That's right. I'm just trying to work out whether I've got control still here or not. Sorry, bear with me. Okay, so we just finished before we paused there on this slide, which is slide 11. That was looking at factors and areas as examples of how we can build the balanced scorecard. If you then look at what objectives look like against some of those example areas, so bear in mind from the previous slide, the first area within financial performance was achieve investment objective. So achieve investment objective is an example of an area on this slide in this chart. And one of the objectives, so there's two objectives against that. One of the objectives is to outperform the liability benchmark by X% over a rolling 3-year period. So an example of a clear quantitative assessment method, against also within the same area, an objective that talks about managing the assets within constraints within the investment schedule, which clearly is not quantitative, but is clearly a pass and fail. So you need to be able to accommodate that sort of aspect within your measurement method as well. And just jumping down to a qualitative aspect, which is the bottom one, providing appropriate training. Again, if you go back to the previous slide, that was within relationship. One of the areas, providing appropriate training. So provide appropriate training with one objective, which is to run at least 3 training sessions, etc. So that's an obvious qualitative answer. You would probably add in something around whether that was effectively delivered, and that would be done via a questionnaire. So we're going to come on to a bit more detail about scoring in a moment. Okay, so hopefully that makes some sense. So turning factors and areas into objectives and weighted all accordingly. And just to emphasize, and to Leanne's point earlier on, and the question that was raised as well, this framework is a framework within which you would bespoke the framework, the factors, the areas, and the objectives, and the weightings appropriate to your scheme and your focus at any particular point. So how does that measurement work? And I'm just going to very quickly show two examples from a quantitative perspective. So again, following on from what we've just looked at here, and then from a qualitative perspective and a pass and fail. So from a quantitative perspective, the scoring will be assessed by objective measurement. So converting an objective into an achievement of an objective into a 1 to 10 score. So here an example in simple terms is the objective to outperform a liability benchmark by 2.6% over a rolling 3-year period. So to achieve or to meet expectations, you would achieve liabilities plus 2.6, which is the emboldened line, and a score of 7 in this example would be achieved if you achieved that or slightly higher than that return. So that is a score of 7. It's not a score of 10 because you don't just want to achieve the expectation, you want to beat the expectations. So to do that, you would score more than 7, but 7 is actually a good score because it's meeting expectations and what was agreed. We would in reality also incorporate a level of risk in here as well to accommodate both sides of that aspect of achieving the liability benchmark plus 2.6 in this case. So just one example of a quantitative assessment and how that would be measured. And you could put a red, amber, or green sort of assessment against that with clear definitions related to these measures. So that's quantitative. From a qualitative point of view, this would be done, certainly we would carry out a trustee questionnaire online. In this case, it's against an objective to provide clear communication and reporting to trustees. So we would pose a question as to whether the reporting provided the trustees with clear communications and reporting. And then we would ask them to say whether they agreed or disagreed in various different ways and score that accordingly in the way indicated on the slide. And again, that could then form a part of a RAG report as well. And finally, on a qualitative basis, what would a pass-fail score look like, or what could it look like? A pass would be a 7, which is meeting expectations. A fail would be a 0 because it's not, in simple terms. And all of those, for all of the objectives, would be scored together and aggregated to an overall RAG status. Okay, so we've covered a lot of areas. We've looked at where objectives and setting objectives sits within the CMA final orders. We've looked at what you need to think about as trustees in terms of what you're trying to get out of this and what is important for you, which then determines the sort of mechanism of scoring. And then we've looked at how a balanced scorecard can be developed and built, and the sorts of factors, areas, and objectives that could be included within that framework. Just in summary then, we think it is inappropriate, and the regulator states that it's inappropriate that advisors should be setting their own homework and setting their own objectives. It is totally understandable that this happened and had to happen to get the initial objectives in place, but we feel that that work needs to develop further, either by the trustees themselves or independently, as we suggest here, within this sort of framework, which we feel is the most effective framework to achieve it, setting clear objectives that can be measured and allowing engagement beyond the trustees with the sponsor, if appropriate, and certainly with their advisors to ensure that the advisors are able to provide the relative information and also are aligned with what the trustees are expecting of them. And that is then reviewed on an annual basis to ensure that the hurdles that we talked about before are able to be raised as time goes on. So we've covered a lot. I appreciate your attention. I'm now going to pass over to Christy to pose a final question.
Thank you. I mean, we've still got some time now to take questions from you. I've got a couple here. I mean, it'd be nice to just hear David and Leanne's perspective on what you've heard today, both from your respective hats as advisor and as a trustee. David, how's your broadband is up and running again?
I'm still blaming my neighbours. I'm taking that, or my wife, or my daughter, or all of the above. But I won't blame BMO's tech. Look, I mean, the metrics proposed. I guess what Peter you're saying there is that you have to set what you're trying to achieve. Are we trying to drive improvements in quality through your sort of high jump methodology or not? So that's quite an important question to answer. And once you've answered that, you'll know how granular you want to be on your metrics. From my point of view, I guess there's always elements of a advisor's work that you can't really measure. And a good example of that, I had a small scheme recently and I advised them not to go into hedge funds. And the real rationale for that was because it's complex. I didn't think they really would understand what they're in. Now, they took that advice, but was that good advice? Well, they can't really measure it because they're not in it. And if it did well, they wouldn't know, and if it failed, they wouldn't know. And had they have not took the advice and gone in, and it did really well, they'd be doing really well, but maybe not understand the product. And so, for me, nothing. You can have all the metrics in the world, and you can have the funding level, you can have the liabilities plus X, you can have a market benchmark, and you should have all of these. But nothing really replaces the judgment of the trustees. Because there's a lot of subjectivity in and around investments. And so I want to be presented with a healthy dashboard with lots of metrics, but nothing's going to take away from the judgment of the trustees.
I would agree, which may disappoint you. But no, I think, I mean, bear in mind that this structure, as I said right at the start, and I think the intention that we've seen from the FCA and the CMA and the Pensions Regulator is to ensure that the trustees have the information to allow them to consider those sorts of issues. Having a framework that measures the strategic investment objectives and having the strategic investment objectives is not the panacea for the answer to all of the challenges that are going to be faced on the investment side. That structure allows, in some cases, to your point, reappraisal of decisions that have been made by trustees. It actually allows trustees, along with other measurement techniques and oversight techniques and so on, to really understand how effective their overall investment framework for governance is as well. So it is focusing on one aspect, but within other provision of information, other challenge to that information and those decisions by the trustee board themselves, as well as them of their advisors. So I think it's this combined with lots of other things that are going to help that sort of scenario that you've just described.
Before I turn to audience questions and answers, Leanne, any thoughts from your side?
Yeah, I think, I mean, David's example of the hedge fund is a good one. I'd say that what's really useful here is or what it gives the framework is understanding why decisions have been made. So in the example of, and it's not all quantitative. So in the hedge fund example that David just gave, the rationale for not investing in it isn't to do with performance. It's down to the governance of the scheme. So the scheme needs to understand what governance bandwidth it has, as well as its risk appetite, etc. And I think it's also, and it is important. There's a lot of there's a lot of demands, as I've already said, on trustee time at the moment. A number of schemes are still going through GMP reconciliation, let alone equalisation. I personally completely understand the pain that the amount of work that involves. You know, there's also the new DB funding code of practice and how that applies, and this as well. But it is, so I think the time and the governance of the trustees is possibly going to be one of the biggest problems or obstacles that trustees face. So actually having a starting point just to help you think. I always think it's easier to correct something, to be presented with something and then make corrections than start from scratch.
Thank you. I see there's a question here directed at you, Peter. Funding objectives in terms of reliability relative conventional and non-controversial, but have you experience of setting measurable objectives in terms of cash flows, expected investment income versus actual planned realizations and reinvestments with actual cost budget? So it's quite a long question, but hopefully you get a gist of that.
I think that's a great question, actually, and reflects how this type of framework, whatever you ultimately end up with, needs to reflect the situation of the scheme specifically at any point in time. So a scheme that is less mature than the one that the trustee is asking a question about won't necessarily have any reference to ensuring that the portfolio is sufficiently liquid to be able to meet cash flow requirements, or is throwing off income to be able to, or want to be able to meet those cash flow requirements contractually or otherwise. So have we, no, we're currently in the middle of an example of a scheme of that type. It's just making sure that, one, the objective, the overriding area within the factor of financial performance is in some way reflecting that. So, because it would probably sit within financial performance, and making sure that the related objective is clear. So, so it is something we would expect to see more and more, and we would expect to see strategic objectives change to reflect schemes as they mature more and more over time. I hope that answers the question, Christy.
Okay. And just general question for the panel, do you see a difference in terms of the approach taken by small schemes versus large schemes, bearing in mind the governance budget that they have?
Shall I carry on the answering?
I was just going to say, there are, I mean, I see huge diversions in what pension schemes are doing just from my day job as in the structuring team. And it's not always down to the size of the scheme, but there is a correlation. I do think the scheme I'm on, obviously, we're technically minded because it's linked to a financial institution. So I do think some of the pressures and the requests of boards that of smaller schemes, that, you know, maybe getting an independent advisor in is rather costly, and it's not something that they necessarily want to, you know, getting it, or an independent trustee is too costly for them really to consider. So I do think that it's definitely stacked against smaller schemes.
It's interesting. I was just thinking, Leanne, when you were talking there, obviously larger schemes, some larger schemes have pensions execs or an executive pension team that sit there in support of trustees to be able to develop this type of framework as well. But even then, we've seen those sorts of teams coming out and asking for the sort of support to develop this framework, which reassures the trustees, I think, on the level of rigor that there is around setting them and measuring them. And then other smaller schemes who are spending an awful lot of time on making sure, when at first they didn't think that they would really need to develop this any further or much further than what they'd agreed with their advisor in December. Once they got into a discussion and realized just how much value they could gain from it, have spent a lot of time on getting it right. So I think it varies dramatically depending on the situation rather than necessarily the size.
Thank you. We've got a few more questions now. Given that trustees are very busy at this time, when is the right time to do this? Perhaps David, I think he's connecting back. Peter, do you want to pick that one up?
Yeah, I don't think there's an easy answer to that. The reality is that at some point the time has to be made to do it, and I guess the key to it, although I would say this, wouldn't I, is finding the governance budget to be able to do it. So if there is an independent trustee sitting on the trustee board, do they have the clearly they have the knowledge and the ability to do it? Do they have the capacity to do it? Is there a subgroup that could be put aside to work on it and focus on it, either themselves or out to an organisation like our own? We are hearing increasingly, actually, legal firms being asked to give a view on this as well, and have been speaking to a number of the pensions practices of the larger firms, who are already working with trustees and are keen to understand how this could be framed. So I haven't answered your question because I don't think there is a good time, but it needs to be done, and at some point this year.
Sure. And maybe that's a good time to bring in the last poll for today, all around whether you're getting, whether you have a third party or an independent, so do you have an independent third party evaluator to help you measure your investment advisor? While that's up, I can ask another question. Maybe David, you can pick this up, which is, what's the difference in approach? You've been an advisor both in kind of an advisory sense as well as fiduciary management. Is there a difference?
Well, I mean, you're trying to do all the same things. So you're trying to bring advice, but there is a little bit more delegation involved. And so for me, very much it's the same metrics, but with different weightings. And that's the simplest way to put it. It does simplify the point about consuming additional advice and it probably racking up costs, but you're more accountable for that chart at the start. If I look at that chart way back and I said, how accountable is your advisor? Well, in a fiduciary model, they're a little bit more accountable for that chart than perhaps in a more standard advisory model. And so, yeah, the difference is the wearing of the performance is higher for the fiduciary management, but it doesn't negate the need to be proactive around new ideas and new strategies that perhaps aren't in your delegated mandate.
Thank you. There's another question that's come in around ESG. Actually, let's just break for the poll. So as you can see, 77% of people don't have an independent third-party evaluator. So that's that could be one way of addressing some of these issues that we have today. Going back to the questions, there's one around ESG. How do you measure ESG in the space? How do you make it quantifiable? Who'd like to pick that up?
Happy to start. I guess first and foremost, I don't think it's fair to say that all trustees understand the element or the level of ESG that's already going on in their strategies. And so the first thing I think you should consider is your policy that's currently being carried out by your managers or your advisor or your fiduciary, is that clear? Is it documented? Do you know what it is? Is it there? Is it accessible? So have you established a clear policy? And your advisor will have helped you to do that. And if they haven't brought it to your table, then that's a miss. The second one is there a regular frequency of review of that? And the third one would be a reporting on the impact of that, be that engagement or in selection or in other metrics. So there's different ways to do that by asset class. But you need to know what the policy is, you need to regularly review it, and you need to have some form of reporting on the impact of that. I think that's how I'd sort of subcategorize monitoring of ESG.
I think just to add to that, so that's I would agree with that certainly. Two things. One is obviously you've got something which all managers who are signatories to UNPRI can point to, which is the assessment report, and what actions they're taking and what their plan is to address any deficiencies in their ratings against that report. And the second thing is the trustees shouldn't forget that there is as well as the investment aspects of that and how the provider is dealing with it, is also how the provider, whether it's an advisor or fiduciary manager, is behaving from an ESG perspective as a corporate as well. So what are they doing in terms of climate impact? What are they doing in terms of their behavior and how they are governing themselves as well, which is equally important, I think.
Thank you, Peter. I can see Rachel's going to tell me I've got 1 minute left. So it seems like looking at the questions, there's quite a few coming through, and we'll certainly look to answer those outside of this. I think, Rachel, you're going to close up today.
I am. Thank you all very much. Perfect timing. Well, thank you very much, Christy, David, Leanne, and Peter, for providing so much information for us. That was all really well done. And thank you for all who joined us today to watch the webinar.